Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. National Financial Literacy Month is celebrated in April, which is a great opportunity for us to check and promote our financial situation and skills. Joining us for this segment, we have Nico Fazio, a director with our U.S. options team at Nasdaq, to discuss the basics of options and how Nasdaq fits into the market. It's great to have you with us, Nico. Welcome to Trade Talks.
Great to be here, Jill. Thank you.
And let's start with the very basics here. What are options? What are some of the benefits and strategies involved?
Sure. So options are tradable contracts that give the owner the right, but not the obligation to buy or sell an underlying stock or index at a predetermined price and time, which is a mouthful. But essentially, options are derivatives, meaning that their value is largely derived from the underlying asset. So at a high level, an Apple call option, for example, will rise in value if the underlying stock, Apple, goes up. And the opposite will happen with a put option. It will rise in value if the stock goes down. So options are listed on most major stocks and indexes and are pretty attractive to investors, I guess, for three main reasons. So number one, options are leveraged. So in the standardized equity options world, one contract represents the right to buy or sell 100 shares of the underlying stock. So traders can tap into a pretty large notional exposure with very little upfront capital committed. Number two, so although like many securities, options can be risky, they should mainly be thought of as a way to control and mitigate risk. For example, an investor with a large position in a stock could buy put options that would rise in value if the value of the stock fell, which mitigates risk with that position. Now, since they are leveraged, the premium or cost of that put that you'd implement into that strategy would be a tiny value compared to what the equity position would look like. And then lastly, options can generate income for your portfolio, which is probably the least known out of the three. So we talked a lot about buying options, but you can also sell or write call and put options. Instead of paying the premium, you're going to be on the other side of the trade. People are going to pay you, like you're going to receive a premium, and you don't have to give it back. However, you are going to be liable if that underlying stock ends up closing profitably and the options exercised. So with the appropriate capital commitments, writing options can really enhance your portfolio's yield.
Are there different types of options, and how does settlement work?
So here in the U.S., about 95% of options volume are called multi-listed options. So equity and ETF options, these are standardized and physically settled. So what I mean by standardized is they trade across all 16 U.S. options exchanges. Each contract gives you the right to buy or sell 100 shares, and you can exercise them before expiration. Whereas the remaining options, which are index options, they're not traded on any physical underlying thing. So they don't settle physically, they settle in cash, and you can't have an early exercise, you can only exercise it at settlement. Now, keep in mind, even though there are different types of options and they can be exercised in different ways, options are traded on exchange just like stocks. You don't have to exercise them. So you can buy a contract for, say, $5 and sell it later for $7, kind of like a stock. Options markets are, pretty efficient. And for most liquid stocks, the retail execution experience doesn't feel all that different than equities.
And Nico, why have options become so popular lately?
Yeah. I mean, I'm sure, since we're in Financial Literacy Month, a bunch of people are watching this, wondering how they work because they are intensely popular and they're continuing to grow, especially in the U.S. So, ever since 2019, when the retail brokerages kind of cut their trading commissions, options have really exploded. That's obviously one of the drivers. A few other things. So accessible investor education through the rise of finance and social media has helped drive some volume. And then, of course, improvements in order execution quality and advancements in exchange technology, also help. And then on top of all that, we've just had really volatile markets in the past few years. So options trade quite well in those. So yeah, I mean, this has really fostered obviously more volume, but at the end of the day, it's created more sophisticated trading strategies over the last few years. And through all of this, importantly, our exchange infrastructure was able to handle record volumes and messages, really well through all that volatility. At the end of the day, and kind of the financial literacy piece of this is that options are complex in nature. It's tough to learn about how they work in a few days. It's actually impossible to. There's a variety of great courses, resources, and educational platforms that do an awesome job at teaching you how to trade options responsibly. Earlier today, I was actually on a panel with Options Play, which is one of the leading options education platforms. And I actually learned quite a bit myself, so really recommend their stuff.
All right. And where does NASDAQ fit into the options ecosystem?
Yeah. So when you think about NASDAQ, the first thing that kind of comes to mind is our famous NASDAQ 100 index or the NASDAQ Composite Index. And, these indices underpin the QQQ ETF, for example, is based on the NASDAQ 100 index. We have our own suite of awesome index options products, the type I talked about earlier, that are all based around the NASDAQ 100 index. And we also have smaller versions of those like NQX and XND. But NASDAQ also powers our markets. So NASDAQ they operate exchanges. We have 3 equities exchanges and 6 options exchanges. So what an exchange essentially does is electronically match buyers and sellers, which especially in options is very important since in options, all the volume actually gets executed on exchange. So what we do, is essentially design options products and fine tune market models to keep the trading experience fair, resilient, and kind of robust, the NASDAQ options exchanges that you see now, the previous slide kind of showed it. They come from both in-house developments and outside acquisitions. So the first, being the PhilX, which is the Philadelphia Exchange, large trading floor in Philadelphia there, as well as the first ever electronic options exchange, ISE. So while NASDAQ is currently the largest U.S. options market by volume, about a third of U.S. volume, give or take, we're still constantly improving our platforms to optimize everybody's trading experience. And, the market structure in options is constantly developing. Liquidity provision is real competitive these days. And we expect further success with these markets. And then another, kind of exciting innovation that we have going forward is that our MRX exchange, as announced last November, will be the first options marketplace to actually be hosted on the AWS cloud in a phased approach in the long term, which we're all very excited about. And then at the end of the day, we talked a lot about NASDAQ's role in US markets, but NASDAQ powers exchanges all over the world. NASDAQ technology is actually used in over 130 exchange groups, all over the world. And while the US options market has certainly grown over the past few years, we're excited to continue working with international partners to drive this technological expansion.
All right, Nico, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.
Thanks for having me.